start following these 3 investing tips from the Oracle of Omaha for improved results. Warren Buffett is one of the greatest investors of all time. You definitely want to check these out. There will be several companies mentioned in this video for example purposes. It's up to you to do your own research before you invest in a company. Nothing mentioned here is financial advice. Let me know in the comments which one tip you'll start using right away. Now let's get into it. Invest in what you know. This is a classic Warren Buffettism, and it's one of the most important pieces of advice for beginner investors. Stick to what you know and understand, whether that's a particular industry, a specific company, or a certain type of investment. You'll be much more confident in your decisions, and you'll be less likely to make costly mistakes. Let's say you are a big fan of Apple because you use their products and services all the time, and you have a good understanding of their business model and the industry they operate in. You might decide to invest in them because you have confidence in its long-term growth prospects and you feel like you have a good understanding of the company's financial performance and competitive position. By investing in a company that you know well, you are more likely to be able to identify important trends and events that may impact the company's performance, and you can make more informed investment decisions. For example, Apple releases a new product or announces a new partnership. You may have insights into how this could affect their revenue and profits that other investors may not have. On the other hand, if you were to invest in a company that you know very little about or have no personal experience with, you may be more likely to make uninformed investment decisions that could lead to poor performance. So, by following Warren Buffett's advice to invest in what you know, you can reduce your risk and increase your chances of success in the stock market. Buy wonderful companies at a fair price. Warren Buffett is famous for his focus on value investing, which means looking for companies that are undervalued by the market. But he's also quick to point out that not every undervalued company is a good investment. You want to focus on companies that are not only undervalued, but also have a strong competitive advantage, a durable business model, and a management team that you trust. If you can find those companies and buy them at a fair price, you will be setting yourself up for long-term success. Here's an example of how to buy wonderful companies at a fair price. Let's say Lumen Technologies has a strong competitive advantage, a durable business model, and a management team that you trust. You have also done some research and analysis and determined that the company's financial performance is strong and that it has a good track record of generating profits. Now, your next step is to determine whether the company's stock is priced fairly or whether it is overvalued or undervalued. One way to do this is to compare the company's current stock price to its intrinsic value, which is the estimated value of the company based on its future cash flows, growth prospects, and other factors. If you determine that Lumen stock is undervalued, meaning that it is trading at a price lower than its intrinsic value, you may decide to buy shares of the company at that price. By buying shares of a wonderful company at a fair price, you can potentially benefit from the company's long-term growth and profitability, while also reducing your risk and increasing your potential for earning a strong return on your investment. On the flip side, if Lumen stock is overvalued, meaning that it is trading at a price higher than its intrinsic value, you may decide to hold off on buying shares or consider selling any shares that you currently own. If you were to buy an overvalued stock, you would be paying more than the company's estimated value, which could lead to poor performance or lower returns in the long run. So, by following Warren Buffett's advice to buy wonderful companies at a fair price, you can make more informed investment decisions and increase your chances of success in the stock market. Be greedy when others are fearful, and fearful when others are greedy. This may sound like a weird piece of advice, but it's actually pretty clever. When the stock market is in a downturn and everyone is panicking, that's often a great time to invest in high-quality companies that are temporarily undervalued. On the other hand, when the market is booming and everyone is rushing to buy the latest hot stock, it may be a good time to exercise caution and not get caught up in the hype. Let's use Disney in this example. They are a leader in their industry, have a strong brand, and consistently generate profits. However, the stock market has been in a downturn and many investors are feeling nervous about the economy, so they are selling off their shares and the stock price has dropped significantly. Now, if you are following Warren Buffett's advice to be greedy when others are fearful, you might see this as an opportunity to invest in Disney at a lower price than it was previously valued. You might believe that the company's long-term prospects are still strong and that the current downturn in the market is a temporary blip. So, you might decide to purchase shares while they are undervalued, with the expectation that the stock price will eventually recover as the market stabilizes and the company continues to perform well. In this way, by being willing to go against the crowd and invest in a high-quality company that is temporarily undervalued, you can potentially benefit from a rebound in the stock price and earn a strong return on your investment. Let me know in the comments which tip works best for you. So, there you have it, 3 investing tips from Warren Buffett. I hope you found them helpful.